Very good morning, friends. So I hope you're all doing well and you're preparing well for your examinations as well. First of all, welcome you all to the initiative taken by the Institute of Chartered Accountants Board of Studies for the revisionary sessions for the students. Well, we're going to start a revision on a very important topic, invariably which comes in the exam. I don't think so we can think of the exam without a topic on financial instruments. I always call this as a pillar to the topic of Indian accounting standards. So financial instruments, as you know, is got a total of three standards. One is Ind AS 32, one is Ind AS 109, and Ind AS 107. So in these two sessions on financial instruments, we are going to revise the concepts as well as do some questions as well. The strategy, I think, just to give you a brief and let's get your inputs on that as well, that we're going to make a little walkthrough first of all on the concept part, of course without getting into details, unlike the regular sessions where the details are given. So we will first of all take a quick recap, just remind ourselves of the major concepts what we have covered in each subtopic in the standard, followed by a practice of questions. Now, first of all, I think before I start, I would also like to tell you that certain key important areas which you see in financial instruments. So we will cover those particular typical issues which invariably comes in the exam. If I will focus in terms of Ind AS 32, I would say that compound financial instruments is what is invariably asked in the exams. So we're going to focus a lot in terms of compound financial instruments, taking a variety of instruments and understanding how the aspect of compound financial instrument is accounted for. And if it comes to Ind AS 109, the focus is more in terms of accounting of financial assets and financial liabilities. And of course, there are other areas as well, which of course are not very frequent in nature, but you will see questions coming on impairment, questions coming in terms of derecognitions of financial assets and financial liabilities, etc. Of course, the idea is to touch upon the conceptual base as well as to do the questions with you. So what I've basically done, collected a total of around 20 super questions, what I call it. And these questions are going to cover the larger concept in terms of financial instruments. So in this particular session today, we will first kick off our inputs from Ind AS 32 and then take the journey in terms of Ind AS 109. So I think let's first take a little recap of the concept. So as I said, I'm going to start with the inputs on Ind AS 32. Now when you look at Ind AS 32, Ind AS 32 of course is called financial instruments. But when we say Ind AS 32 financial instruments, this is dealing with the presentation aspect. This is dealing with the presentation aspect. Now, I hope I can take a little liberty, considering that you've already made your attended the regular sessions, and now you're looking for a revision. So I hope I can presume that, of course, you've come with a revision as well, so that we can consolidate the concepts as well. So I think I'm going to make some quick mind maps for the purpose, and which is going to revive the concept. So let's begin with the first aspect of presentation, and let me first make the mind map number 1. Since we know the name of the standard is supposed to be presentation, my first focus comes in terms of how the financial instruments are presented in the balance sheet of the issuer. Because when you're looking at the focus on the presentation part, our focus is how would the issuer present the financial instruments in the balance sheet of the company. So I think first what we will map in our mind is, let's say this is how the balance sheet looks like. And this is the equity and the liability section. Though of course it starts from the asset side, but we're just making an extract balance sheet to understand how the instruments are presented. So considering the equity and the liability side. So we've got the section, first is equity, which is comprising of equity share capital and it comprises of other equity. And we also know that when we present the liabilities, typically the non-current liabilities, you've got financial liabilities, which is borrowings. So this is just the extract of the balance sheet to remind ourselves in terms of presentation of a financial instruments by the issuer in the balance sheet of the company. Now, we already know one thing very clear, that when a company issues a financial instruments, it gets classified either as an equity instrument, or it gets classified as a financial liability, or it becomes a compound financial instrument. Typically, you can say the instruments from the point of view of the issuer is either going to be equity or financial liability or a compound financial instrument. So considering that input, I think let's put it like this, that we've got a total of, you can say, three kinds of instruments. So when you say the company issued an equity instrument, the equity instrument is going to be presented under equity share capital. So when a company is issued an equity instrument, it is going to be presented under equity share capital. When the company is going to issue a pure financial liability, it is going to be presented under financial liability, that is borrowings of the company. But when it comes to a compound financial instrument, the compound financial instrument is supposed to be split. And you would recall that it is split between equity as well as, you can say, the financial liability element. The equity element or the compound financial instrument is presented under equity. So the equity component gets presented under other equity, and the financial liability element is presented under the non-current liability. So I think this is one thing which should immediately come to your mind, that the presentation of the financial instruments from the issuer perspective has got a total of three categories. If it is an equity instrument, it gets presented under equity share capital. If it is a compound financial instrument, it is split and the financial liability is appearing as borrowings, and the equity is presented under other equity. And just to remind you, when you present this in other equity, it is shown as a part of statement of changes in equity. It is shown as a part of the statement of changes in equity, SOCI. And if you see in the regular sessions, you would recall that this is presented in the tab number 1 as far as SOCI is concerned. Okay, so that makes a mind map one, a very basic one. Keeping the name of the standard presentation, we're looking at how do you present the financial instrument. Okay, let's go to the next one. Now, the next input, what comes to the mind is, I'm making a mind map number 2. You can, of course, make value additions to these mind maps as well. I'm just trying to cover the concept and then go to the questions. So first, we're going to spend a little time making the conceptual base and then move forward. I hope the strategy works, that we get some inputs from your side on the chat as well. So I hope the strategy is good, that we first make a little conceptual framework, remind ourselves, and then we start attacking the questions as well. Okay, now let's go further. In order to decide from the issuer point of view, that when do we classify the instrument as a financial liability or an equity instrument or a compound financial instrument, we would apply a simple 3-step model. I remember when we took up this topic in the regular sessions, of course, what we were talking of was the version 1, the version 2, and the version 3. So today, of course, as my mind map, I'm just going to consolidate and consider the inputs in terms of the version 3. So we're going to apply a simple 3-step model. So we're going to apply simply a 3-step model in terms of taking a decision whether the instrument is financial liability, equity instrument, or a compound financial instrument. Now, in this particular case, number 1, in terms of step number 1, what we need to put across a question is, does the issuer have a contractual obligation? The presence of the obligation has to be contractual in nature. Otherwise, this standard cannot trigger. So we need to keep a focus in mind that does the issuer have a contractual obligation? The focus is on the word contractual obligation. So we need to see that does the issuer have a contractual obligation? So I think I'm putting the focus on the word contractual obligation. Just to recall, when you look at an obligation, for example, an income tax payable, it's not a contractual obligation. Because when you pay the income tax to the government, it is an obligation which is statutory. It is an obligation which is by law. So it does not fall under the ambit of a contractual obligation. So your focus needs to be that is the obligation by contract. So when we look at a contractual obligation, just keep it in the mind. When you look at Ind AS 37, the obligation is supposed to be legal in nature. It's legal or constructive. I'm just connecting the dots. When you look at in terms of Ind AS 37, the obligation is legal or constructive. Now, legal obligation is much wider in nature. Because when you consider a legal obligation is by law as well as by contract. But in this case, you can say we're talking of a part of a legal obligation. It's not completely legal in nature. Because legal is a wider term. It includes by contract and by law. So this is just by contract. So I think just to avoid confusions later, when you make your revisions on the other standard, so we can say this is not legal. Because when you say it is legal, it is by law as well as by contract. Legal obligation is by law as well as contract. Here, we're just looking at one element of the legal obligation, and that is obligation by way of contract. So when you say, does the company have a contractual obligation, you'll end up saying either a yes or you'll end up saying no, there is no contractual obligation. Now, when you say that there is no contractual obligation, the standard is not applicable. Financial instruments would not apply. But when you say a yes, then we go on to the step number 2. We're just making a quick revision in terms of reminding ourselves that, when do you say the instrument is, supposed to be covered under the purview of the standard? Then we go to the step number 2. In terms of step number 2, now the focus is on the mode of payment. I think that is the crucial point of classifying the instrument as financial liability, equity, or a CFI, as the case may be. So we need to focus on the fact that what is the mode of payment. Now, as far as the mode of payment is concerned, more or less, just to map our minds, there are basically exhaustive mode of payments, at least considering the examination point of view. Of course, I'm not talking of those cases where there is exchange of financial instruments under conditions which are potentially favorable, etc., potentially unfavorable, etc. We're not covering that part. But typically when you're looking in terms of the mode of payment, either the mode of payment is cash or the mode of payment is shares. The company uses its own equity shares as a currency note, and this is the kind of language which you need to put in the exams as well, that when there is a mode of payment and you're putting a subjective question, not MCQs I'm talking of. So when you say that the mode of payment is supposed to be shares, you can always use the word that shares are being used. Shares are being used as currency notes. Shares are being used as currency notes in this case. So you can use the word that shares of the company is being used as a currency note in order to discharge the obligation. So you got to see that the mode of payment is cash or it is shares. When you say the mode of payment is cash, we need to stop and see. We need to stop and see, are you deciding about the principal element? Are you deciding about the principal element, or are you deciding about the return element? Because obligation of a company is comprising of two elements: the return, the interest and dividends, and the principal. So when you're looking in terms of the return, we're looking at in terms of interest, we're looking in terms of dividends. So immediately you should take a pause and decide that which element of the obligation are you evaluating, because you need to run the three-step model separately for each component of the obligation. Run it separately for the liability, for the return element, run it separately for the principal element as well. So we'll take a pause and we will decide that, okay, if this is principal, then what is the wordings used in the question? If it is supposed to be principal, then you will see the words redeemable. You'll see the words irredeemable. So you notice the words which are used in the language of the question. That is it redeemable? If it is redeemable, then that component is a financial liability, because you've got an unavoidable obligation to pay. And as I'm making some revisions at the moment, I'm not putting questions to you. But once I come to the practical questions of revision, I'm certainly going to put questions back to you. So if it is redeemable in nature, it becomes a financial liability. And if it is irredeemable, it becomes an equity instrument. So many people get a little confusion that when they see the mode of payment is cash, they jump to the conclusion it's a financial liability. No. You need to first of all watch out that is there an unavoidable obligation to pay? Because when the mode of payment is cash, it becomes a financial liability only when there is an unavoidable obligation to pay. So I think let's put that as a small input. So we can say when the mode of payment is cash and there is an unavoidable obligation to pay. There is an unavoidable obligation to pay. So it's only when there is an unavoidable obligation to pay, then it becomes a financial liability. Simply if the mode of payment is cash is not the deciding factor. You also need to prove that there is an unavoidable obligation to pay cash. Coming further on the next input, when you see the return, you will see the word it's either mandatory in nature, or we will see that it is either discretionary in nature. So either the interest or the dividends are mandatory, or it is discretionary in nature. If it is mandatory, it's a financial liability, and if it is discretionary, it becomes an equity instrument. So the moment you see that the mode of payment is cash, this chart should immediately flash your mind, and it should tell you that, okay, we are basically, in a nutshell, evaluating that there is an unavoidable obligation to pay. So the words which indicates unavoidable obligation to pay is mandatory returns, and there is redeemable principal amount as well. And as the mode of payment is shares, we go on to the step number 3 to make the evaluations. Let's go to the step number 3. Now, when the mode of payment is supposed to be shares, my mind immediately starts telling me that now we need to see that the instrument is derivative or is it non-derivative in nature. When the mode of payment is cash, we do not make any assessment whether it is derivative or it is non-derivative in nature. But when the mode of payment becomes shares, you need to catch up with the point that nature of the contract. So we can say when the mode of payment is shares, when the mode of payment is supposed to be shares, you need to focus. When the mode of payment is shares, you need to focus, and the focus point in this case is nature of the contract. So when it is mode of payment cash, then it does not make a difference to me. But when the mode of payment is shares, you need to focus on the nature of the contract. And you need to decide that is the contract derivative in nature? Is the contract derivative in nature? or is the contract non-derivative in nature? So we'll look into the fact, is the contract derivative in nature or is the contract non-derivative in nature? And let me also remind you at this stage, another way of looking at financial instruments is you see that is it a pure derivative contract, is it a pure non-derivative contract, or is it a case where there is an embedded derivative? That's what you call hybrid instruments, which contains, not only a debt equity element, something like compound financial instruments, but also contains a derivative. Typically, when you look at compound financial instruments, which has got an optionally convertible feature, the presence of that option to convert introduces a derivative element in the instrument. And in those particular cases, we say that there is a derivative embedded in the instruments. But I think, let's not talk on that as of now. So when you decide that it is derivative or non-derivative in nature, your mind should immediately tell you that there are a total of 3 characteristics with which you decide the instrument is derivative in nature. And all those 3 conditions need to be met. All those 3 conditions need to be met. So in this case, we've got 3 parameters. We've got a total of 3 parameters, and you need to meet all those parameters. You need to meet all those parameters to say that it is supposed to be a derivative contract in nature. Number 1, we can say the value depends upon an underlying asset. The value of the contract is dependent upon an underlying asset. It does not have an independent value. It derives its value. It depends means it derives its value from an underlying asset. That's feature number 1. The second feature is that there is going to be a future settlement. The second feature is that there is going to be a future settlement. And the third feature is that it is got, you can say, zero or negligible investment at the beginning. It has got zero, or you can say negligible investment at time 0. Put it as TO. So all these 3 parameters need to be met before you can call the instrument as a derivative in nature. It derives its value from an underlying asset. It's going to be settled at a future date, and there is either negligible or zero investment at time 0. When all these features are met, it becomes a derivative instrument in nature. And I think the pure examples of all the derivative instruments is supposed to be options, forwards, and future contracts. They're all supposed to be, you can say, pure derivative contracts in nature. Now, what is important at this stage is that when you say it is a derivative contract, then there is a different test which is applied. And when you say that it is non-derivative in nature, there is a different test which is applied. So when it is non-derivative, you apply what is called a fixed test. And when it is derivative, we apply what is called a fixed for a fixed test. So in terms of testing a derivative, we've got fixed for fixed test. And when you say it is non-derivative, then we apply what is called a fixed test. Let me make a separate chart indicating the parameters of the fixed for fixed test and the fixed test. So I think when the mode of payment becomes shares, you're using your own equity shares as a currency node, you need to be a little more careful. The first element is to segregate its derivative, non-derivative in nature, and then deciding that which test is to be applied in terms of evaluating the inputs. So I think let's make a chart out here. So when you're looking at the step number 3, and we are saying that it is a non-derivative, or we are saying it's a derivative contract. So we just said in terms of non-derivative, we would apply a fixed test. And when it is a derivative, we would apply the fixed for a fixed test. So what is important is to recall that what do you see in terms of fixed test? and what do you see in terms of fixed for a fixed test? So when you look at the fixed test in this particular case, you are looking at the number of equity shares. We're looking at the number of equity shares to be issued to discharge the obligation. And in this case, you would remember that when you say the number of shares, either the number of shares is fixed or the number of shares are variable in nature. If it is fixed, then we say it is an equity instrument, and if it is variable, then it becomes a financial liability. The fixed stands for the number. So you just need to see that the number of equity shares issued against the instrument is going to be fixed, then it is equity, otherwise it becomes a financial liability. When you say it is a fixed for a fixed test, so there are two things to be seen. One is we need to see that the number of shares are fixed in nature. The second is the consideration. The second is the consideration, and the consideration is also supposed to be fixed in nature. So you need to see that the consideration received is going to be fixed. The number of shares issued against that consideration is fixed. So in this case, you've got two combinations. So we can say both are fixed. So both are fixed in nature. That means the number is fixed as well as the consideration is fixed. So if both are fixed, it becomes an equity instrument. And you can say any one or both are variable. Any one or both are variable in nature. Then it becomes a financial liability. Right, so I think that gives me a three-step model, quickly maps my mind in terms of how do you decide things. That was a mind map number 2. So we've seen the presentation in the balance sheet of the company. We've seen the parameters with which you decide, is it equity, financial liability, or is it supposed to be a compound financial instrument? So just to recall, you would refer to those 3-4 charts which we did in the regular sessions, wherein we said if the mode of payment is shares, then what do you decide? Fixed and variable. If the mode of payment is share, cash, then you need to see, is it mandatory, discretionary, redeemable, irredeemable? And if it is a blend of both the factors, you accordingly decide. That I think takes care of my first block of revisions with you. Now it's time to go to the compound financial instruments. Right, friends, I hope you're able to recall the concepts as I write down and as I remind you the inputs, what we discussed. I hope you're able to catch up with the thoughts and you're able to revise well. So what about consideration about a non-derivative if variable and fixed on both the cases, it'll be equity instrument. Yes, if you say that the consideration is fixed and the number is fixed, both are fixed, then it is equity. Any one is variable, both are variable, it becomes financial liability. So you can say rest all the combinations are covered here. So now you're talking about non-derivative. Okay, for a non-derivative, we just look at the number. For the non-derivative, you just look at the number. Consideration is not to be seen. Because if you recall, we said in terms of non-derivative instruments, consideration is already received. It is only the allotment of shares which relates to the future. But in terms of derivative, the consideration is yet to be received. And therefore, the different test applies. Because when you look at a non-derivative, you are saying consideration is already collected. It's only the number which relates to the future. So only the number would decide, is it equity liability? Consideration has got no role to play. But in terms of a derivative instruments, the consideration is yet to be collected. So the consideration and the number both are going to play a role for a derivative instrument. You're welcome. Okay, so this part is done. Let's go further. So that was the mind map number 2. You want me to quickly make some charts on the combinations as well, or I think this is good. You can ask for it. You can give your inputs and suggestions in between. So you want me to make some charts on that combinations, that if the mode of payment is only cash, only shares, a mix of shares and cash, then whether it is liability, equity, etc., or we can go to next stage. Okay, I'm getting a question. Yes, I am getting yes, we need this. Okay, I'll do that. So, is there any difference between a perpetual instruments and irredeemable instruments? Well, the word perpetual is nothing but irredeemable. Now, in terms of irredeemable instruments, you would recall that when the instruments are irredeemable in nature, it all depends upon whether the coupon rate, the contracted rate, is equal to the market rate. It would be technically incorrect to say that if a company issues irredeemable or a perpetual debt instruments, we cannot say that it's going to be a compound financial instruments. For perpetual, or we can use irredeemable debt instruments, you need to decide that is the market rate and the contracted interest rate is same or not. If the contracted and market rate is same, it's a financial liability. But if the contracted rate is less than the market rate, then it's going to become a compound financial instruments in that case. But perpetual, irredeemable can be used interchangeably. Because I think they get confused that perpetual only by equity or this. Yes, I think you got your answer on that, right? So I think when you're looking at a perpetual debt, irredeemable debt, just compare the contracted and the market rate and take decisions and you'll get the inputs. I hope that answers your question.
सर
Yeah.
एक्चुअली माय डाउट इज कि वो इररिडीमेबल जो है फॉर इक्विटी इंस्ट्रूमेंट कैसे हो सकता है इन व्हाट केस इट कैन बी इक्विटी
नहीं,
इंस्ट्रूमेंट
इररिडीमेबल बेटा इक्विटी कंप्लीटली नहीं होगा। देखो, जब आप ये कह रहे हो एक इंस्ट्रूमेंट का प्रिंसिपल और इंटरेस्ट कंपोनेंट है, तो आपने कहा प्रिंसिपल इरिडीमेबल है, तो उसको आप इक्विटी कह रहे हो। लेकिन अगर उसका इंटरेस्ट भी डिस्क्रिशनरी है फॉर दैट मैटर, तो फिर वो इक्विटी बन जाएगा। मतलब आपने कहा उस पर इंटरेस्ट डिस्क्रिशनरी है, तो रिटर्न डिस्क्रिशनरी होगी, इक्विटी, और प्रिंसिपल भी इरिडीमेबल है। अब मैं उन परपेचुअल इरिडीमेबल डेट इंस्ट्रूमेंट्स की बात कर रहा हूं जहां पर आप ये कह रहे हो दैट नंबर वन इट इज इरिडीमेबल, लेकिन उस पर इंटरेस्ट दे रहा हूं मैं। इसका मतलब इंटरेस्ट मैंडेटरी है लेकिन प्रिंसिपल इरिडीमेबल है। फिर मैं कंपेयर करूंगा उसका कॉन्ट्रैक्टेड रेट और उसका मार्केट रेट। अगर कॉन्ट्रैक्टेड मार्केट रेट सेम हो गया देन इट बिकम्स फाइनेंशियल लायबिलिटी, और अगर कॉन्ट्रैक्टेड रेट मार्केट रेट से कम हो गया देन बिकम्स अ कंपाउंड फाइनेंशियल।
ओके सर थैंक यू
यू वेलकम। Okay, so I think as everybody's requesting for quick charts, I think let's make some charts as well. So I am going to make a total of, I would say, 3 charts. One, the mode of payment is cash. One, the mode of payment is shares. And one, the mode of payment is a mix of cash and shares. That will give us the input. So I would also request that, once the session happens today, it would be a good idea that, you go back and make your revisions, keep making revisions of the questions which you have practiced in the study material, RTPs and all, keep closing as you make revisions as well. Okay, so the first one we are considering, the mode of payment is cash. The chart number one which we are making is the mode of payment cash. And let's consider 3 columns in this case. One is we are considering return, one is we are considering principal, and one is we are considering the nature of the instrument. So I think let's call this as a mind map number 3. So let's call this as a mind map number 3. So this is my third mind map which I'm creating. Now the combinations in this case is, we can say the return is mandatory, or the combination is it is discretionary, it is discretionary. We're just trying to create permutations, combinations in this mandatory, discretionary, redeemable, irredeemable, redeemable, irredeemable. Well, let me caution you that if you look at the perpetual debt, it becomes a little more exception to this chart where you compare the contracted and the market rate. But I'm not inserting that at this stage. Okay, so when it is mandatory and redeemable, I think we can get some quick answers on the chat box as well. I think since this is, making revisions on that, let's get your inputs on that. Yes, this becomes a financial liability and this becomes a compound financial instruments. Good. discretionary and redeemable in nature, and that is going to become, that's right, a compound financial instrument. Good. And if it is supposed to be discretionary and irredeemable in nature, that becomes an equity instrument. Super. So I think this takes care of all the permutations in terms of the mode of payment being cash. Second, we're making the second chart where we're considering the mode of payment to be equity shares of the company. Now, in this case, you'll see only two combinations. Either the number of shares are going to be fixed or the number of shares are going to be variable. Because generally, what you're going to see in this case, just to give you a formula, because you're going to see that the examiner will give you a principal with a compounded rate of interest. The principal is compounded with a rate of interest for n number of years, and this is divided by the fair value of shares today. This is divided by the fair value of the shares today. So this means that we are pre-deciding the shares. It is fixed in number, and therefore it becomes an equity instrument, because you're taking a predetermined number in this particular case. The other one is that you consider the principal compounded with the rate of interest for n number of years, and we take the fair value of shares on redemption. We take the fair value of shares at the time of redemption, that means at a later date. So which means we are considering variable in number. And if you're considering variable in number, it becomes a financial liability. That makes a chart number 2, that is the mode of payment is shares in this case. Let's go to the chart number 3, which is a blend of these factors. So where we're considering the mode of payment to be cash as well as shares. So in this particular case, let's consider the return in cash and the principal in terms of shares. So I'm assuming that the return is going to be given in cash and the principal amount is payable, let's say, in shares. So we will look at the nature of the instruments in this case. So we can make permutations, combinations in this case again. Mandatory, discretionary, and let's say this is variable and fixed, variable and fixed. So I think let's get your inputs on this side now. So the first one is financial liability, that's rightly said. And the second one is compound financial instruments, very good. Then discretionary variable, the third one also becomes what? Compound financial instruments, superb. And the last one is going to be equity instruments, that's very rightly said, great. So I think that takes care of our inputs in terms of classification of the instruments. Now we can come to the core part, and that is on the accounting perspective. Okay, so let's go to the next part now. We are now going to make our mind map number 4. So now we're going to work upon the mind map number 4. So first we looked at the presentation, then we looked at the 3-step model in terms of identifying the nature of the instrument. Then we made our permutation combinations of chart, which is nothing but application of the 3-step model. Now, the standard Ind AS 32 is focusing mainly in terms of accounting for a compound financial instruments. So in this particular case now, we're looking at the accounting of compound financial instruments. I think let's make a wonderful chart based on the accounting. Now my mind is thinking of a lot of permutations, combinations. First, let's talk journalistic, and then we can talk of different kind of compound financial instruments. And I think what we need a clarity is in terms of reminding ourselves that when you consider the financial liability element in the CFI, which elements do you consider? Do you consider interest? Do you consider principal or not? So first, let's talk journalistic. So in terms of compound financial instruments, when you do a split accounting, when you do a split accounting, you need to consider the proceeds as a base. You need to consider the proceeds as a base, and the proceeds are split. The proceeds are split in terms of financial liability and in terms of equity. We split the proceeds of the instrument in terms of financial liability and equity. So I think what comes to mind is, when you consider the financial liability, you take the present value of the future cash flows. Without getting into nitty-gritties at this stage, you would consider the present value of the interest, and you will consider the present value of the principal, and that is discounted at a benchmark rate. And what is that benchmark rate? The benchmark rate is that you need to consider the coupon rate which prevails on a non-convertible instrument. So what you need to keep in mind is, when you consider the financial liability, it is based on the present value of the future outflows. And the present value of future outflows, the discounting rate is the benchmark rate, the interest on a non-convertible instrument. So when you consider the financial liability, we consider the present value of future cash outflows. We consider the present value of the future cash outflows, and we can say generally the future cash outflows will be in terms of interest as well as in terms of principal. But we will see in specific, looking at different kind of instruments to map our minds. But when you consider the present value of the future cash outflow, the present value is based on the discount rate. It is based on the discount rate which is on non-convertible, which is on a non-convertible instrument. So remember, when you consider a discounting rate, you need to consider the discounting rate. This becomes the benchmark rate. This is what we decided in our mind is the benchmark rate. That you need to consider the coupon rate which prevails on a non-convertible instrument, just to be on a very safe side. That also tells me that if the question is giving you an interest on a non-convertible instrument, it is indirectly also trying to tell me that it is a compound financial instrument as well. Just in case, that can also be helpful. And then when you consider the equity element is nothing but it is the balancing figure. You consider the proceeds of the instrument, and from this you reduce the financial liability element. The balancing figure becomes equity. Okay, now I think before we do questions on this, let's, I think, first of all also make an interesting chart, an extended version of this mind map 4. Because when you look at compound financial instruments, what comes in the mind is, it is OCD, it is supposed to be MCD, it is supposed to be PCD, or it is supposed to be a perpetual debt instruments where the contracted rate is less than the market rate. Let's get this again. When you look at a compound financial instruments, if you remember, when we were looking in terms of the regular sessions, we dealt with variety of compound financial instruments in those cases. And the different kinds of compound financial instruments, one is a perpetual debt, where the contracted rate is less than the market rate. It becomes a CFI. There is an optionally convertible instrument. There is a mandatorily convertible instrument. And there is a case of partially convertible instrument. So in all these cases, your mind needs to be clear that when you consider the financial liability, do you consider principal or do you consider the interest element in those cases? So I think let's make a quick chart on that. Then we can start our inputs on the practical illustrations. So I'm looking at different categories of compound financial instruments. So various types of compound financial instruments. So let's give you the various types and let's consider the interest and let's consider the principal I think this time let's put some questions back to you, and you can help me in terms of deciding this as well. So on the types of the instruments, I'm looking at perpetual, I'm looking at a perpetual debt where the contracted rate is less than the market rate. So I am looking at, when you go to consider the financial liability computation, when you look at the financial liability computation, whether we will consider interest and principal. Let's come back to you. So when you consider a perpetual debt, do you consider interest and the principal, or just the interest element is taken in the calculation of the financial liability? And that's right. We just consider the interest element. The principal element is not taken to calculate the financial liability component. Good. Number two, we are looking at optionally convertible debentures, for example, OCD. So in terms of OCD, do you consider interest and the principal element? The option is with the holder in this case. He says, I want the principal in cash. I say, okay, sir. So in this particular case, I am, of course, considering that this is the option with holder. So if it is an option with the holder, we will consider the interest and the principal elements both. Great. Next, we are looking at partially convertible debentures. Are we going to consider the interest and principal? Yes, we will consider interest principal, but the principal will be only on the non-convertible portion, not on the convertible portion. So the interest is a yes, and this is only non-convertible portion. This is going to be only the non-convertible portion which will be taken in the financial liability calculations. And let's put the fourth one to you, which is a case of mandatorily convertible debenture. So which elements are you going to consider for a mandatorily convertible debentures? And that's right, just the interest element and not the principal element. I think this is one thing which needs to be very clear in the mind. Super. So I think now we are ready to do some questions on compound financial instruments with you. Now we can start the exercise. It's been almost around 50 minutes we've spent condensing the financial instruments learnings in the form of 4 mind maps. Now let's come to the question with you. So let me just zoom this across. We picked up some examination questions. Calling this as super 20 questions to be revised in this case. Let's, I think, read. I hope it is visible, friends. You can see the question carefully. Visible to you, I believe. Okay, that's wonderful indeed. Now let's, I think, read the inputs. We Limited issued convertible bonds on 1st April 18. The bonds have got a life of 5 years with a face value 20, and they offer interest at the end of each year at the interest rate 4.5% per annum. The bonds are issued at their face value, and each bond is convertible into 1 ordinary shares at any time in the next 5 years. Companies with a similar risk profile recently issued a debt at 6% per annum, but without the option for conversion. As you read that the coupon rate is 4.5% and the interest rate on a non-convertible instrument is 6%, I think that is quite indicative that this is what nature of instrument? Complete the sentence. So when you read the inputs, that the coupon rate is 4.5 and the interest on a non-convertible instrument is supposed to be 6%, it gives you a feel that that's right, it is a compound financial instrument in nature. And in this case, we can say that we're going to convert each bond in terms of 1 equity share, which means fixed number of equity shares are going to be issued in this case. So the derivative is going to become equity in nature. So in this case, when the derivative becomes equity in nature, the derivative is not segregated out of this instrument in this case. You're required to provide the appropriate accounting entries for the initial recognition as per the relevant standard in the books of the company. Calculate the stream of interest expenses across the period of 5 years and provide the accounting entries in the holders of the bond, elect to convert the bonds to ordinary shares at the end of the 4th year. So I am given the clear-cut status that in this particular case, we need to first of all get the initial recognition, get the interest for the next 5 years, and then if the redemption, if the holder says at the end of 4th year, not 5th year, that I want the shares, what do? I think let's do one thing, initial accounting followed by the leisure account. So let's, I think, do this. So this is the solution to question number 1. So first of all, on the initial recognition, you need to do a split accounting. So you will first of all show the split accounting to the examiner, dividing the proceeds in terms of financial liability and the equity element. So let's consider first of all the proceeds from the question. So we can clearly see that these bonds were issued at 75 lakhs, that is the proceeds. And nowhere I can see in the question that I am given any status. I'm given any status regarding the fact that this is a case of partly convertible or mandatorily convertible. So this is optionally convertible, and I can get that inputs it is optionally convertible by the issuer because it says holders elected to convert, and I think that is quite indicative that this is an optionally convertible instrument. So we will consider the interest and principal elements both. So first of all, we will pay interest at the rate of 4.5%. So we can take the financial liability calculations. On the financial liability calculations, we'll consider the interest on 75 lakhs. Let's take interest at the rate of 4.5%. And you need PVIFA, which is at the rate of 6% for a period of 5 years. Let's get the PVIFA in this case. So 1 divided by 1.06, 1, 2, 3, 4, 5 GT. It's, I think, 4.212. You can take 3 or you can take around 4 decimal places for accurate results. So if I calculate this, this is coming to around 1421. This is 1421,550. And then we also consider the principal element, 75 lakhs, and this is going to be discounted PVIF. See, this is A out here, but this is PVIF, 6%, and that is 5th year end. If you maintain the calculations carefully, you'll never ever go wrong. So 1 divided by 1.06, 1, 2, 3, 4, 5, that's 0.747. And this will give us the present value of the principal element, 56 lakh 2,500. So I think just to show the figures carefully to you, just add the principal interest and the principal elements. That's going to give you the financial liability element. So let me just add the two. So 1421,550. This is, I think, coming to 70 lakh 24,050. That is the financial liability element. Okay. Then I think we can comfortably consider the balancing figure that is supposed to be equity. Out of 75 lakhs, you reduce this amount, and that comes to 475,950. 475,950. This answers the first requirement of the question. You know, if you look at this, this is the first requirement of the question. Many people at times ask me, so do we present the answer like this? Oh, well, why not? You can present it in a more aesthetical manner, but this is right now looking pretty good, so you can present it in a more ethical manner. I mean, as you find the presentation good, but just for understanding, I've segregated the liability and the equity element. Okay, now let's go to the second part of the question, the stream of interest calculations. Many people at times, they always make an amortization chart for the interest calculation. I prefer to make ledger accounts. You can make the amortization chart as well. That's a complete choice. But I prefer that, instead of making an amortization chart, the ledger account gives you a complete feel of getting things. So I think I'm going to make the ledger account, because in any case, I need the status for the fourth year. So in order to get the interest calculations, let's consider the financial liability ledger. And let's first of all record bank. And this is going to be 7024050. 7024050. Now, what are we going to do at this particular stage? When you record the figure through the bank account and are now supposed to segregate the finance charge, yes. At what rate? At 4.5% or at the rate of 6% on NCD? That's right, at the rate of 6%. So we'll take the finance charge. So in this particular case, let's take this 1 year, 2 years, 3 years, 4 years, and 5 years. Since we are required to calculate the interest for all the 5 years, let's put it like this. 70,24,050, we take a 6% interest, that is 421,443. And we make a payment. What is the rate at which the payments is made? Is it going to be the coupon rate? Yes. So this is at the rate of 6%, and this is at the coupon rate, which is 4.5% on the face value. So on 75 lakhs, we take a 4.5%, that is 337,500. We take the balance CD as a balancing figure, and I think you can now make this continuous calculations. I'll quickly fit in these calculations. The balance CD becomes a balancing figure. Let's, I think, first of all, fill in the data. And we get bank. Then we take a balance CD balancing figure. At least once we get the formatting, it becomes easy. And this is, I think, a good way. Once you make a ledger account, you're pretty confident that your calculations are correct. Last year, I would avoid calculating the finance charge. You can rather consider the interest as a balancing figure. So in this case, it can be bank, or it could be a payment through bank and equity share capital plus premium. I'm just filling this for the time being. I know in the third requirement, the question says that the holder wants to convert to ordinary shares at fourth year. But right now, the objective is to calculate the interest. And when the objective is to calculate the interest, if the holder says, give me cash, you put down bank. If he says, I want shares, you split between the face value and the premium. So right now, we're just putting it like that. So this comes to 7024 050 421 443 70 lakh 24 plus 421 443 minus 337 500. So this is, I think, 7107 993. 7107 993. Again, take a 6% on this. 426 480 approximately. And we take the balance 7107,993, 426 480. This is 337,500. That comes to 7196 973. 7196 973. This is 431 818. This is 337 500. 7196 973, 431 818. 72 91 291. 72 91 291. So little clerical calculations, and then again 6%. That's 437 477, and that's 337 500. 72 91 291, 437 477. So this comes to 73 91 268. 73 91 268. Now, as I said, I'll avoid considering the interest in the last year. I'll take it as a balancing figure for convenience of calculations. So what is the payment? You will pay the interest 337 500. And can you tell me what else? What is the amount to be paid at the end of fifth year? Considering whether he takes shares or considering whether he takes cash, can I say I'm going to pay the principal amount? And that's right. So 75 lakhs principal amount will be paid. So I think it's good to take the interest as a balancing figure in the fifth year. 75 lakh, 337 500, 73 91 268. So this is coming to 446 232. So that answers the requirement second as well. We have segregated the interest charge. For each of the 5 years, the interest stands calculated. The question is not complete. We were only given the status to calculate the interest in the second part. Now there is a third part. Let's go back. So the entries and initials is done. Though I did not show the accounting entries, but I think let's do that as well. So when it comes to the journal entry, the entry is going to be bank gets a debit, 75 lakhs. The financial liability component gets a credit. The equity gets a credit. And this is going to be 7024 050. And this is 475 950. That is the entry at the inception. So the part number 1 is done, interest is done. Then it says what is the accounting entry if the bondholders convert them into ordinary shares at the end of the 4th year. So we're converting at the end of the 4th year. Let's now go to the third part. So let's take the input in terms of the part number 3. So if they convert at the end of the 4th year, can I take the leisure of the 4th year and do the needful? Of course, yes. So let's now consider the leisure for the 4th year, because the holder exercised the option to convert at the end of the 4th year. So we're going to consider this. So we're just considering the 4th year leisure in this case. Copying the information, 72 91 291, and the finance charge, that is 437 477. Okay, now what do we do in this particular case? Can I say, first of all, we are going to pay the interest, and the interest is 337 500. Can I say now the principal will be split in terms of the share capital and the security premium, correct? So I think let's now get the inputs from your side. Can you tell me how much will be the equity share capital and the share premium when they convert at the end of the 4th year? Let's get that from you. So we have taken the inputs in terms of things. Now we need to consider how would you do this conversion. So we will also consider the element of the equity as well. The equity component is also there, which is to be tackled as well. So tell me, friends, what is, because all the question I've done, so what is the split between the equity share capital and the security premium when the conversion is required at the end of fourth year? Waiting for your answers on that. If you look at the balancing figure at this stage, I'm just calculating the balancing figure. The balancing figure is coming to 73,91,268. So this is to be split between the share capital and the premium. So what is the amount of the equity share capital? I didn't get any answer so far. Oh my God. Now let's come back on the agenda. It very clearly says the bonds are issued at a face value and each bond can be converted into one ordinary shares at any time. Now let's look at the calculations carefully. Can I say this 75 lakhs of bond is at the rate of 20? So can we get the number of bonds at this stage? Let's calculate the number of bonds. So 75 lakhs divided by 20, it comes to 3,75,000 bonds, correct? Now I am clearly given that it says each bond will be converted to one share. So am I given the face value of the shares? No. So I presume the face value of the shares to be 10 rupees each. So you would give one share for every one bond. So 3,75,000 is the number of shares to be given. So we can do the calculations at this stage. So we're going to issue 3,75,000 shares of 10 each, and the rest you can take as a balancing figure, that is premium. So this is going to be 37,50,000 because we're issuing one for one, and let's take this premium as a balancing figure. So this is going to be 72,91,291 plus 437, 477, 3750, 337,500. This is coming to 36,41,268. Now, the other input, which is to be taken care, there is an equity component of the CFI which is standing in the statement of changes in equity. What are you going to do with that? Once the bondholder says that the bondholder says that I want shares, so what are you going to do with that? We decided that in the regular sessions as well, that what is the treatment of the equity component at the end of the year? It is transferred to share premium, that's correct. So let me, also remind you that if the holder says I want a cash, I'm going to transfer that to the capital reserve. If the holder says I want shares, I'm going to transfer it to the share premium. So let me put this back out here. So I think let's put an input out here in GIR. So can I say if the holder says I want cash, if the holder says I want shares, if he says I want cash, it is transferred to capital reserve. And if he says I want shares, it is transferred to share premium. So the money in the equity component is going to be transferred to the share premium as well. So I think this is what we need to make a mention at this stage. So along with this, we can say the equity component in SOKI, in this case, since he's asking shares, will be transferred to share premium. So this is another input which you need to tell to the exam. Wow, the question is complete. So this was a comprehensive question on an optionally convertible instrument where you can see that we did the split of the initial calculations. Now there is another small little agenda before we do another question coming to my mind. I think let's work upon that. So this is my special issue. Mind map number 4 was done. I think the last one was mind map number 4, right? So let's give you 5. It was 4, correct? So before we proceed further, let's give you a mind map number 5. I gave you 4 mind maps. This is the 5th one indeed. Is it the 5th one? Yes, this was the fourth one, so this is the fifth one. Now let me tell you what is coming to my mind. When you look at a compound financial instruments, what should come further to the mind is the treatment of a transaction cost related to the CFI. That's another important input. So we want to look into the treatment of TC. We want to look into the treatment of TC, that is transaction cost related to CFI. So how do you tackle the concept of a transaction cost related to a compound financial instruments? I think that's another important element to watch. So in this particular case, what you need to do is you will apply a 3 steps again. If you see that there is any transaction cost which is given on the compound financial instruments, we will apply a simple 3 steps. So can I say in the first step, you will split the proceeds between liability and equity, ignoring any element of transaction cost. So we will do the split between financial liability and the equity, and this is ignoring any transaction. So you will calculate the split between the financial liability equity, ignoring any transaction cost. Second, can I say the transaction cost will be apportioned between the financial liability and the equity component in the ratio of that split proceeds. So the transaction cost is allocated. It is allocated in the ratio of financial liability and equity, which is computed in step 1, which is computed in terms of step number 1. And now, would you like to remind me what is to be done in the third step? Once you've calculated this transaction cost between the equity and the financial liability, what do we do? Can I say the TC related to FL gets reduced from the FL, and that triggers complete the sentence. Once you reduce the transaction cost for the financial liability element, it triggers, and you need to calculate what? That's right.
Yeah, 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 yeah.
Very good. So can I say the transaction cost of financial liability is reduced from FL, and this will trigger the calculation of the new effective interest rate, which might be given the question. Otherwise, we've also covered this aspect in the regular sessions. How do you calculate a new effective interest rate in this particular case? And what about the transaction cost of the equity component of CFI? Can I say this is reduced from retained earnings? This is reduced from the retained earnings. It's not taken in the P&L, but it is directly charged in terms of retained earning. So I think this is another important element in terms of fact that when you're considering this, you need to see that the FL component gets adjusted from the FL and leads to a new AIR. The equity component is not taken in the P&L, but it is directly charged in terms of retained earnings in SOCI. Okay, so far so good. That's done. Now let's go further. So maybe we can, leave some questions in between for your levels. We can maybe come to some interesting questions further. Okay, so I think let's consider the question number 3 now. It's a June 2019 examination question. So let's have a look at the question number 3. It's June 2019, came for 12 marks in the exam. So let's have a look at this June 2019 question. It says the company Perfect issued compulsory cumulative convertible preference shares, triple CPS. The rate of dividend is 10% payable at the end of every year. The preference shares are convertible into 12,500 equity shares of the company at the end of 5 years from the date of allotment. So this becomes compulsorily convertible. So when you were to consider the financial liability component, are you going to consider the principal element in the calculation of financial liability? So this is right, that some part of the TC never goes to P&L which pertains to equity. Yes. Whenever there is, something which you can say journalistic to Indian accounting standard, if there is anything which relates to equity shareholders, it never hits the P&L. For example, you would recall that even when in terms of consolidation, there is a change in terms of the percentage stake. You acquire more shares and the control is still there, or you dispose shares and the control is gone. The difference in those cases gets adjusted to equity. The dividends, in a very normal example, the dividends which is paid to the equity shareholders is also reduced from the RE directly. So anything pertaining to equity would never hit the P&L. It gets adjusted in the retained earnings direct basis. Correct. Okay, so I think we got the answer on that we're not going to consider the principal element in this case. Let's read further. Then he says, when the triple CPS are issued, the prevailing rate on a debt without conversion is 15%. That is indicating that in this particular case, it's a compound financial instrument. The transaction cost on the effective date is 2% and effective interest rate is already given to me. Wow. You're required to compute the liability and the equity component and pass journal entries for the entire term of the arrangement from the issue to the conversion to equity shares, keeping the provisions of the relevant AS and the discounting factors also very clearly given in the question. Wonderful. So I think now we can work out the solution to the question number 3. Now, in this case, we can see that there is a TC. So I think we need to apply my 3-step model. First, we do the split accounting. Then we allocate the TC between the two components. And then we will adjust the TC in the financial liability and then make the ratios. Let's begin. So we will first of all consider the split accounting. We're going to first of all consider the split accounting in this case. So let's consider the proceeds and let's see what is the proceeds of the instrument. We issued a total of 50,000 triple CPS at the rate of 180 each. So this is 50,000 at the rate of 180 each. So this works out at 50,000 into 180, that's 90 lakhs. And we split this between the financial liability and the equity component. So in terms of financial liability, we just go to consider the interest because the principal is convertible to ordinary shares. So let's see the coupon rate. The coupon rate is given to me, it's at the rate of 10%. So we're going to consider the interest element on 90 lakhs. At the rate of 10%, we need a PVIFA, which is at the rate of 15%. How many years? This is at the 5 years. So we can take the cumulative factors from the question itself. Let's just add the factors given in the question. Since it is given, we just go to consider the same data. 8696, 7561, 6575, 5718, 4971. It's coming to 3.3521. 3.3521. So this is going to give us the financial liability element. This I think comes to 30 lakh 16. This is coming to a total of 30 lakh 16,890. So we can get the balancing figure that is equity component in this case. So minus 90 lakhs, this is 59,83,110. So that takes care of my step number one, splitting the proceeds between the financial liability and the equity component. Now, what do we need to do next? We need to consider the transaction cost. And what is the transaction cost? It is 2% on the value of the proceeds in this case. So we can say the transaction cost is on 90 lakhs at the rate of 2%. That comes to 1,80,000. So this is my step number two. Indirectly, we need to divide this 1,80,000 between the FL and the equity. So let's divide this between the financial liability and the equity, and this would be in the ratio of financial liability and the equity, which you've computed in the very first step. So this is going to be 30,16,890 by 90 lakhs into 1,80,000. I think this is coming to 60,338. Just check the calculations if this is correct. 60,338, and this is the balance 119,662. Just see if this is correct. Yes, that's right. Wonderful. Okay, now with this, we can go back and decide. I think let's decide the inputs here itself. So let's see the financial liability element. The financial liability will be now 30,16,890 minus the TC 60,338. So this will give us the net financial liability, which is to be accounted for. 30,16,890, 60,338. This comes to 29,56,552. And this is going to be accounted at the rate of 15%, or this is to be accounted at the new rate, that is 15.86. When you're going to make a ledger account, so you're going to consider 15%, or you will consider the new EIR, which is 15.86%. That's right. Wonderful. So we will account this at the new effective rate, which is 15.86%. Okay, let's, I think, first make a ledger account for this. Let me just go back to the requirement. You're required to compute the liability and equity component. That's done. Journal entries are required for the entire arrangement, but I am going to make ledger accounts in this case, from where you can make your entries. So let's make the ledger account of the financial liability for a period of 5 years. So this is going to be bank, the net figure 2956, that is 2956,552. We take a finance charge. So we need this for a period of 5 years. It was 5 years, right? So let's make the ledger for 5 years, 2, 3, 4, and 5. Let's first finish the structure. So you make a payment, that is bank, get the balance CD. We then take the finance charge. We make the payment, that is bank, we get the balance CD. Finance charge. We take the bank figure, get the balance CD. Then again we take the finance charge. Then we make the payment, balance CD, and then we get balance CD. Now, finance charge last year will not compute. We'll take it as a balancing figure for convenience. And we're going to pay the interest, and the rest is principal, is equity, share capital, and premium. This time I'm going to ask you the split between the share capital and the premium. Last question I did that. this question I'm going to ask you the data. So let's calculate the interest at the rate of 15.86. This comes to 468,909. And what was the interest paid? It was 9 lakhs. So the interest paid is 9 lakhs on 90 lakh at the rate of 10%. That's right. 29,56,552, 468,909. This comes to 25,461, 461. That's 400,538. This is 9 lakhs. So 25, 461, 4,538. This comes to 20, 25,999. This is 20, 25,999. Again, we calculate the interest, 15.86, 321, 323. This is again 9 lakhs. 20, 25,999, 321, 323. And this comes to 1447, 322. 1447, 322. That's 229, 545 approximately. And this is again 9 lakhs. So 1447, 322, 229, 545. This is coming to 776. 776. And this is going to be 776, 776. Now tell me what is going to be the bank figure. I've written equity, share capital and premium, but do you think the equity, share capital and premium will appear in this ledger, or it will be allocated from the equity component of the CFI? So when you're going to consider the allotment of shares on a mandatorily convertible instrument, so is it going to get rooted in the financial liability, or is it going to be through the equity component segregated at the start? What do you say? This is of course 9 lakhs. So are you going to record the allotment of shares through this ledger account or separately? Separately. The equity component will be used to make the allotment of shares, for which we'll do the entry. So now let's take the finance charges balancing figure. This is 123 and 224. Let's see if this is approximately coming to 15.86. Let's make a check. I think yes, it is almost same. If you take the calculation 15.86, it is almost the same, just the difference around 27 rupees due to rounding of factors. Okay.
Why separately, sir? Can you please explain?
Sorry.
Why separately? Not from the.
Okay. In this case, when you took the financial liability element, the financial liability element is just the present value of interest. So if you logically see what you've done, you've taken the present value of the interest elements and then you're unwinding it back and making payments, right? So you've taken the present value of all the 9 lakhs, no principal. Then you unwind it back and you make the principal payment 9 lakh. So the ledger account will become 0. Because this element does not include the principal element. So in this case, you will not be able to allot shares in this ledger.
Right, sir.
In terms of optionally convertible debentures, what happens when you consider this element, it is the present value of the interest and the principal both. So when you make the unwinding and pay the interest, the principal is still pending. Right. So you can say that in terms of partially convertible, the money left over will be only the cash component for the principal. In terms of mandatory convertible, nothing will be left over. In terms of optionally convertible, the principal interest will definitely get left over. That's how you can map the things.
सर पार्शियल में कैसे करेंगे? पार्शियल में कैसे बताया आपने?
पार्शियल में आप लोगे प्रिंसिपल ओनली जिसका पोर्शन कैश में देना आपको, राइट? तो पहले आप
नहीं,
लॉजिक ये सोचो,
जब कन्वर्ट
आप
करेंगे
सर ये माइंड मैप भी बनवा दीजिएगा प्लीज, ये वाला।
अच्छा पार्शियली भी करवा देंगे, नो प्रॉब्लम। पहले मैं
नहीं सर,
एक
ये तीनों
चीज आपके
तीनों
माइंड
वाला
में
तीनों वाला माइंड मैप बनवा दीजिएगा, ये तीनों
ओके
पार्शियली।
कि आप कह रहे हो कि इक्विटी कंपोनेंट एंड में किस लेजर में क्या है।
यस।
यस।
ओके मैं एक बार पहले डिस्कस भी कर लूं। देखो, इफ यू आर कंसिडरिंग कि इट इज ऑप्शनली कन्वर्टेबल, तो आपने फाइनेंशियल लायबिलिटी में प्रिंसिपल इक्विटी दोनों लिए, दोनों, तो इधर इक्विटी अलॉटमेंट आएगी। पार्शियली कन्वर्टेबल में आपने इंटरेस्ट और सिर्फ वो प्रिंसिपल लिया जो कैश में देना है, तो इक्विटी अलॉटमेंट इधर नहीं आएगी। और अगर आप मैंडेटली कन्वर्टेबल की बात कर रहे हो तो उसमें सिर्फ इंटरेस्ट लिया, प्रिंसिपल नहीं लिया, तो इक्विटी अलॉटमेंट इधर नहीं आएगी। इन अदर वर्ड्स, जहां आपने फाइनेंशियल लायबिलिटी में आपने वेर यू कंसिडर दी प्रिंसिपल अमाउंट, उधर अलॉटमेंट आएगी। तो ऑप्शनली कन्वर्टेबल में आएगी, न पार्शली में आएगी, न मैंडेटरी कन्वर्टेबल में आएगी। आई शो यू दैट आल्सो, नो प्रॉब्लम।
है ना? पार्शियली में आधी तो लिया है, तो वो भी नहीं आएगी।
पार्शली में बेटा जो आपका इक्विटी कंपोनेंट अलग हुआ था उससे इक्विटी शेयर की अलॉटमेंट होगी। देखो आप एक बड़ा बेसिक लॉजिक लगाओ, 3 इंस्ट्रूमेंट्स है, ऑप्शनली कन्वर्टेबल, उसमें आपने प्रिंसिपल लिया कि नहीं लिया? लिया,
लिया।
तो अलॉटमेंट फाइनेंशियल लायबिलिटी लेजर के थ्रू होगी। मैंडेटरी कन्वर्टेबल में आपने प्रिंसिपल लिया, नहीं लिया, तो अलॉटमेंट फाइनेंशियल लायबिलिटी हो नहीं सकती।
नहीं होगी।
पार्शली कन्वर्टेबल में आपने प्रिंसिपल कौन सा लिया? जो कैश में देना है,
कैश में देना है।
तो अलॉटमेंट फाइनेंशियल लायबिलिटी हो नहीं सकती।
अच्छा।
इसका मतलब मैंडेटरी कन्वर्टेबल में अलॉटमेंट इक्विटी कंपोनेंट से होगी, पार्शली कन्वर्टेबल में इक्विटी कंपोनेंट से होगी, ऑप्शनली कन्वर्टेबल के अंदर फाइनेंशियल लायबिलिटी लेजर से होगी, और वो जो इक्विटी कंपोनेंट है वो शेयर प्रीमियम है।
Got it.
Okay, so this is done. Now let's come to the allotment of shares. So we need to put an entry for allotment of shares as well. So in terms of allotment of shares, now let's see, take the equity component in this case. So we take the equity component. What was the equity component? It was 5983. It was 5983,110. Now we'll allot the equity shares and the premium through this case. I think now you can easily tell me the number of shares to be credited. He's very clearly said, we will issue 12,500 shares of each. So how much will you give a credit to the equity share capital? Very clearly the number of shares with the face value.
1,25,000.
Correct. So 1,25,000 will be given out here, and the rest you can take as a balancing figure. That is the premium balancing figure. So 59,83,110 minus 1,25,000. This is going to be 58,110. Super. Right. So this takes care of the allotment of the shares also in this particular case. Wonderful. So we've done 2 cases on compound financial instruments. If you see, we've done the case where there is optionally convertible. We've done the case where it is mandatorily convertible with the element of TC. And how does the TC gets taken care? That is also done. Okay, so I think let's now take a break. Okay, let me also tell you friends, today I would be taking the session till 9:30, but don't worry, the half an hour which is going to be here pending from my side, I'm going to take it on Tuesday. So Tuesday when we're going to get the session, we are going to extend another half an hour because of some work. I'm already pre-informed for this as well. So I'll be continuing the session till 9:30, and Tuesday, please remember that we're going to get the session at 7 to 10:30 in the morning. I hope that works. I hope that's not a challenge to anyone.
Perfect, sir.
Wonderful. So I think let's take a quick 10 minutes break, 10, 12 minutes, and I think we'll be back and we'll do, what you said, partially one as well. We'll do that. So enjoy a break, relax your minds. I'm going to see you in 10, 12 minutes back. Thank you. station of mind. So, as you said, let's do another question on a partly convertible debenture. Then I think we'll make a little mind map. I think typically relating to the last year of the company, that when you're making a financial liability, does the allotment of shares takes place through the financial liability or the equity component? We'll make a little mind map on that part as well. But first, let's, I think, do a question on that area. So I think this is the question number 2, which I have put on partly convertible. Yes. So this is on the partly. I have actually taken questions on all the permutations, combinations. So this is on the partly convertible part now. That's again an examination question, November 2019. It came for 10 marks in the exam. So let's, I think, first read the inputs in this case. It says we limited issued 80,000 convertible debentures of 100 each on 1st April 15, and they are due for redemption on 31st March 19, 4 years later, at a premium of 20%, convertible into equity shares to the extent of 50%. So when it says to the extent of 50%, that means it is partially convertible in nature. And the balance is settled in cash to the debenture holder. The interest rate on a conversion debenture without conversion is 12%. I think that is quite indicative that it is a compound financial instrument, because the coupon rate on this particular debenture is 8% and without conversion is 12. And it says the conversion qualified to equity qualifies as fixed for fixed, which means that the option to convert is supposed to be equity. And I think just let you remind this as well. When you say that there is an option to convert, the option to convert gives rise to a derivative which is embedded in the instrument. And if the option to convert meets the fixed for fixed test, then it is called equity. And then you don't segregate the derivative element embedded in the instrument. But if it does not qualify for a fixed for fixed test, that means it fails the fixed for fixed test, then it is supposed to be a derivative financial liability which needs a segregation. I don't remember that in any of the questions in terms of compound financial instruments, the equity conversion option would have failed the fixed for fixed test. But if it fails the fixed for fixed test, I think we discussed that in the regular sessions as well, that in those cases we will segregate 3 elements of the instrument. One is the financial liability, non-derivative. One is the financial liability, which is derivative, and the equity becomes a balancing figure. So what you need to basically consider in the mind is that if the option to convert meets the fixed for fixed test, it is equity and not segregated. Then you segregate only 2 elements of the CFI, the equity and the financial liability. But if the equity conversion option fails the fixed test, then it is a derivative financial liability which needs to be segregated. Then you will segregate 3 elements: the financial liability derivative, that option, the non-financial liability component, and the equity component. So in this case, we are safe. It very clearly says it meets the fixed for fixed test. You're required to separate the debt equity components at the time of issue and show the accounting entries at the initial recognition only. So that's great. We are not required to do anything except the entries at the initial recognition. But I think for understanding, we're going to take this leisure, for later stage as well. And then it says the following present value factors are defined. Let's solve this. Solution number 2. So this is now on a partially convertible. Just to remind the chain, my question number 1 was optionally convertible. The question number 2 is partially convertible. The question number 3 was mandatorily convertible. I did not take the case of a perpetual debt. I think that's pretty easy. So first we're going to do the split accounting. Let's take the proceeds and split this. So if we look at the proceeds, we're given 80,000 debentures of 100 each are issued. So 80,000 into 100, that works out at 80 lakhs. And this proceeds are to be segregated in terms of financial liability as well as equity. So when you consider the financial liability, now the question rises, are you going to consider both interest and principal, or only a portion of the principal, which is the non-convertible portion? What do you say? It's partially convertible. So in the FL, do you consider the entire principal or only non-convertible portion? And that's right, 50%. So as far as the interest is concerned, we are given the interest is at the rate of 8%. So on that 80 lakhs, there is an 8% interest. We take the PVIFA. This is at the rate of non-convertible is 12%. So we take the PVIF at 12% for a period of 5 years. So I think since the factors are given, let's take the factors from the question: 0.887, 788, 701, 625, 557, 3.558. And principal, we will consider 50%, which is payable in cash. Anything else to be considered at this stage on the principal amount? Are we considering something else also in this particular case? Because we've given some more inputs in this particular case as well, that the amount is going to be payable at a 20% premium. So can you see, if we were to pay a 20% premium, yes, we need to add the 20% premium as well. So let's take it as 1.2 times. And this is PVIF at the rate of 12%, which is 5th year end. So let's consider the values. This is going to be 0.557. The present value is 0.557. So let's take the present value of the interest and the principal. So 80 lakhs, 8%, 3.558. This is, I think, 22, 77, 120. 20% premium, 557. This is, I think, 26, 73, 600. So we can take the total of the principal and the interest obligation in this case. So 22, 72, 22, 77, 120. This is, I think, coming to 49, 50, 720. So this is the value of the liability component. Then we can consider the equity as a balancing figure. 80 lakhs minus this figure, the balance is the equity amount. So this is, I think, coming to 49. This is 80 lakhs minus 49, 50, 720. This is, I think, coming to 30 lakh, 49,280. Correct. Right. So I think this takes care of the element of the equity component as well. So this is done. Okay. By the time, I think I've taken the P factor 5 years. Is that 4 years? I think the table is given for 5 years, but I think it's redemption after 4 years. So I think I need to rectify the figures. Is going to be 0.625. Let's please rectify the present value factor. And this is also going to be 4 years. So we need the factor for a period of 4 years, and this is 4th year end. The table is giving us 5 years factor, but its maturity is 4 years. So let me just rectify the calculations. This is 0.625. 4 years would mean 0.887, 788, 701, 625. This is 3.001. Okay, so now let's take the calculations of this. This is 80 lakhs, 8%, 3.001. This is 19, 20, 640. And this is 50%, 20% premium. This is, I think, coming to flat 30 lakhs. So this will give us the liability element. I think it's 49, 20, 640. So now let's consider the balancing figure. This is 80 lakhs minus 49, 20, 640. This is 30 lakh 79,360. Just see if the calculation is correct. Yes, great. So this gives me the equity element of the instrument as well. Now, the question technically is over because the question is not asking us anything beyond the initial recognition. But since we requested, we're going to go a little further. The question is saying that we need to segregate the debt equity elements, which is done, and the entries at the initial recognition. But I want to make the ledger account for 4 years to give you a complete understanding of this. So let's make a ledger account for 4 years. So financial liability, and we consider the figure by bank. Let's first create a structure for 4 years. 1, 2, 3, and 4. So financial liability is 49, 26, 40. 49, 26, 40. So let's take the finance charge. Then we make the payment. We get the balance CD, balancing figure. Then again take the finance charge, make the payment, get the balance CD, balancing figure. And again take the finance charge, make the payment, get the balance CD, balancing figure. So now let me ask you, is the allotment of shares going to take place through this ledger, or will it take place through the equity component?
No.
Yes, right. Not from this ledger. So we're just going to make a payment, which is the interest and the principal amount. Let's, I think, complete the ledger. Then we'll make a mind map on that part as well. So 49, 26, 40. The coupon rate is 12%. 590, 477. And the payment we made is 8%, 6 lakh 40. So 49, 26, 40, 590, 477, 640. This comes to 48 lakh 71, 117. 48 lakh 71, 117. This is 12%, 584534. To make the payment 6 lakh 40. 48 7 117, 584 534. This comes to 48 15 651. 48 15 651. 12% would mean 578. No, 577. 577 878. Then we make the payment 640. So that becomes quite a clerical work indeed. So this is 47, 53, 529. 47, 53, 529. Now we're going to make a payment. We'll take the interest as a balancing figure in the last year. So you're going to pay 6 lakh 40, and how much further principal amount is going to be paid? Same figure which is there in the financial liability calculation, right? 50% of 80 lakhs with a 20% premium. That's what we're going to pay at this stage. Yes, 48 lakhs. 50% of 80 lakhs with a 20% premium. Now let's take the interest as a balancing figure. This is coming to 686,471. Just see if this approximately is coming to 12% on the opening. I think it's not matching because of the factors given in the question. There seems to be, some difference. Anyway, I think the present value factors, which is maybe a little misprint here and there. Anyway, this is how the ledger will get closed because of the factors. There could be a little discrepancy on the calculation. Anyway, now let's come to the equity component, which we had segregated. So the equity component will now be used to allot the equity shares and give a credit to the share capital and the premium. So let's see what is the equity component. 360. Now let's see what is the amount of equity shares. Am I given what is the number of shares to be given? No. I'm just given the status that there will be a issue fixed for a fixed number, but I'm not given the number. So I'm not in a position to segregate because of the lack of data, because the question is not even asking us for that. We can't even segregate that what is the face value and what is the premium. Otherwise, now you know how you will segregate. So we will segregate the face value out here, and whatever is the balancing figure, that will be taken to the share premium.
They are not given
Yes,
because
please.
they are not asked.
Sorry,
They have not given because they have not asked for
they
it.
did not ask for it. Yes, exactly. They asked for the initial entry itself.
Sir, I have one question. Sir, why we are not considering that the premium value during the split of that the financial liability and the equity, that portion?
No, we did the premium. You can see that we've taken the 20% premium on that amount.
Okay, fine, sir. Thank you.
You're welcome. Okay, now let's make a mind map. I think since you were asking, so this becomes the mind map number 6, right? Where we're looking at the equity component status for CFI. Mind map 6, correct? I think so.
Yes, sir. Yes.
Yes, great. So let me just add a mind map 6 out here. So let's make a mind map 6. And this mind map is going to give us the status of the equity component in the CFI. So let's do one thing. Let's make something whether a balance in the financial liability will be left or not. So let's make it an interesting one. So let me make a chart out here. So I'm typically looking at 3 kinds of compound financial instruments. So in this chart, I'm looking at the status of financial liability and equity of CFI at last year. So my focus right now is to see the status of the financial liability and the equity component of CFI in the last year. So let's take optionally convertible debenture, let's take partially convertible debenture, and let's take mandatorily convertible debentures, or you can say compulsorily convertible debenture. Well, I'm using debentures, it can be preference shares as well, but I'm just using a generic term. My idea is optionally convertible, mandatorily convertible, and partially convertible. So let's segregate this in terms of 2 parts. Now, I'll remind you something, just hear this carefully, and you'll get the map as well. Financial liability and equity. Now, you need to tune your mind in this manner. When you consider a financial liability of an optionally convertible instrument, you take the principal and the interest. So when you take the split accounting, though we have done this in earlier chart, you take the interest and you take the principal both. So now let me ask you a question based on this. So do you think the allotment of equity shares will happen through the financial liability? You've taken the interest and the principal both. So do you think the allotment of equity shares will happen through the financial liability? Yes. So we can say in this case, the allotment of equity shares the allotment of equity shares will appear in the last year, ledger. Okay, now coming to the equity component, can I say on the equity component, this will be transferred depending upon if the holder says, I want cash, I'm going to put this in capital reserve. If he says, I want shares, I'm going to put this in share premium. So we've already seen the question number 1 on this area. So you can refer to the question number 1 in terms of the treatment. And this was question number 2. And this was the question number 3. Okay, let's now go to the next element in this case. If it is a case of partially convertible debentures, let me remind you the chain. In terms of partially convertible debentures, we took the interest and the principal on the non-convertible portion only. So when you did the split accounting, we considered the interest and we considered the principal. We considered the principal only on the non-convertible portion. So now tell me, are you going to see the allotment of shares in this ledger in the last year?
No,
Considering that you've taken this, correct. So allotment of shares will not appear. Allotment of shares will not appear in the last year because you have not taken this as a part of the liability calculations. So can I say the allotment will appear out here? You will take the equity component and segregate the face value and the premium at this stage. So this will be the allotment. You'll see the allotment through the equity component in this case. Great. Now let's see further. So now we're looking at a compulsory convertible debenture in this case.
Sir, can
So
you
when
please
we did
explain
this-
this once more?
Yes, I'll do that once again. You're talking about
PCD.
PCD, right?
Yeah.
Okay. So I think let me just connect all the 3 dots points very carefully. You see, when you consider the financial liability for a optionally convertible debenture, you take the present value of interest and principal both. So your ledger is including interest, principal both. Since it is including interest, principal both against the principal, you may land up allotting the shares. So you will see the allotment of shares in the liability ledger itself. And therefore, this equity component will simply go to cash, a capital reserve, or premium. Second, if it is partially convertible debenture, when you take the financial liability, you consider only the interest and the principal which is payable in cash. So which means you've not taken the principal. You've not taken the principal against which allotment of shares will take place. So in this case, allotment of shares will not appear in this ledger. And the allotment will take place through the equity component. And same goes with this case as well. In a mandatorily convertible instruments, you're going to take the interest only, no principal. If there is no principal, allotment of shares cannot take place through this ledger. So you're going to see the allotment through the equity component. Right? I hope I stand clear.
Yes, sir.
Yes.
Thank you.
Great. Wonderful. So in this case, we can say we will consider only the interest, no principal. So can I say the allotment of shares? So the allotment of shares will not appear. Last year, when you make a ledger account, you will not see, they will not appear in this ledger. Here again, the allotment will take place in this case itself. So you're going to see the equity component, the share capital, and the premium. So you will see the allotment through this component. Wonderful. So I think this is an interesting mind map which summarizes the entire concept of a compound financial instruments, considering the various combinations of compound financial instruments in this case. So far, so good. I hope now you can connect all the dots. Let's go further.
This was not in your, sir, we did not make this chart last time also, no, sir?
No.
So we have added one chart for you, sir.
Yeah. I keep on adding new things. I think thanks to the students as well, keeps pushing us in terms of doing new things as well.
Yes, thank you.
You're most welcome. Thanks to you as well. Okay, now let's, I think, come to another agenda. Now, this question is based on another agenda, and I think I need to first give you the inputs on that agenda. Ind AS 32 is not complete. There is another interesting issue in terms of Ind AS 32, which is on the repurchase of compound financial instruments. Because in this particular case, the issuer approaches the holder and tells him that I want to repurchase the instruments. So this is mind map 7, right? I think it is mind map 7, what I rightly remember. Yes. Okay, so this is the mind map number 7. Now, let's recall the concept. We are looking at repurchase of compound financial instruments. It is called repurchase, or we call it as early redemption. It is repurchase, or what is called early redemption. So what happens? The holder, the issuer approaches the holder before the maturity of the CFI and tells them that I want to repurchase the instrument. So what do you need to do? Let's, I think, map the mind. First, you're going to do the split accounting as usual and do the accounting. Till the date of early conversion, you make your ledger accounts after the split accounting. And then you need to consider the repurchase price and do the split accounting all over again. So in this case, let's make it again a 3-step model. So what we're going to do, first of all, we will do the split accounting. We will do the split accounting. The proceeds, as usual, will be segregated in terms of financial liability and the equity component. So normal accounting would apply in this particular case. Second, we can say on early redemption. On early redemption, or rather, first let's do one thing. Let's make a ledger account. So in step number 2, prepare ledger account. We're going to make a ledger account in this particular case, and you're going to make a ledger account for the financial liability up to the date of early redemption. So there is nothing different in this particular case as well. The split accounting will be done absolutely in the usual manner, and the early redemption will be done absolutely, the financial liability absolutely in the usual manner. Equity, of course, remains the same, because you would not have touched the equity component in this case. So you make a ledger account up to the date of early redemption. Then comes the step number 3. That is on the early redemption. That is on the early redemption. So can I say on the date of early redemption, what do you need to do? You need to compare. You need to first do the split accounting. So we can say the offer price which is offered will be split between the financial liability and the equity component. Now, the question arises in this particular case, the important question which arises, when you do the split accounting at this stage and you take the financial liability, can I say the present value is using a discount rate on non-convertible instrument? When you do the split accounting at this stage, you're again going to consider the present value, which is the discount rate again on non-convertible instrument. Is the discount rate in step 1 and is the discount rate in step 3 going to be same, or is it going to be different? When you do the split accounting, you would have taken the non-convertible instrument rate prevailing on that date. So is that the same rate, or is it going to be a different rate? Can be different. It is different, yes. So this is a non-convertible which is prevailing on the date of early conversion. So this is the one which is prevailing on early conversion. This is the one which is going to prevail on the early conversion. So you need to be careful that this split accounting is going to be based on the rate which is prevailing on the date of early conversion. You get the values in this case. Now, what do you need to do further? So in this case, now we will do the comparisons. So we're going to make a comparison. So one hand, we get the book value, which is based on step number 2. And we've got the, you can say, the split values, which you've got in step number 3. So you will compare what is the book values in the step number 2 and the split values in step number 3. So as far as the financial liability is concerned, and as far as the equity element is concerned, so can I say financial liability, you will compare the book value versus the split value. So where do you take the difference? You will basically de-recognize this amount, passing the entry, financial liability gets a debit, the bank gets a credit, and where will you take a difference in this entry? That's right, profit and loss. And when you consider the equity component, comparing the difference in this case, here again the difference will arise. You will put the entry, equity component gets a debit, bank gets a credit. So this difference now you can very well decide it goes in RE, equity. So it is taken directly in terms of equity. You're going to take this in the retained earnings. Great. So let's just connect the dots. So what we decided in this particular case is when there is going to be an early redemption, an early repurchase by the issuer of a compound financial instruments, you need to consider split accounting, normal way. Do the ledger accounts up to the date of early conversion, up to the normal manner. So there is no difference in step 1 and step 2. Split accounting done in a normal manner, and then you decide, make a ledger account up to the date of early conversion. The only exercise which is required is you compare the book value in step 2 versus the split in step 3. The difference in FL goes in P&L, the difference in equity goes in terms of retained earnings, equity direct. Let's have a look on this. I just maybe take a quick walkthrough. I may not solve this question at this stage. Maybe we can give you one to try, of course. But this will finish the element of Ind AS 32 in this case. Let's read. On 1st April X1, the company issued convertible debentures with a face value maturing on March X6, 5 years later. The debentures are convertible into equity shares at a conversion price. This is not redemption at a premium. This is not redemption at a premium. This is the price at which you will convert the debentures to equity shares. It's not premium on redemption. Interest is payable annually in cash. On the date of issue, it says non-convertible debts would have been issued at a coupon rate of 30. On 1st April X4, that is much before the date of redemption, the convertible debentures have got a fair value. This is the offer price. P makes a tender offer to repurchase the debentures which the debenture holders accepted, and on the date of repurchase, it says we could have issued non-convertible debts at 10%. So in step 1, you would apply a 13% coupon. In terms of step number 3, you will apply a 10% coupon. So it says, give us the entries recording the equity liability components at the time of initial recognition and at the time of repurchase. So what you need to do in this case, do the split accounting at the rate of 13%, then make the ledger accounts up to the date of repurchase, and then again do the split accounting at the rate of 10%, and then compare the book values of liability and the split in step 3, book value of the equity and the split in step 3, differences adjusted. I think I should give you answers to get this. You want to try this in homework? I'll see if I can give you an answer on this. Let's give you an answer. The gain or loss. Try this. So I think you are going to get on the financial liability. On the financial liability, you're going to get a loss. If you're not able to do it, I'll do it in the next session. So you're going to get a loss to the extent of 25,260. And on the equity component, you're going to get a gain 38,660. So once you do the equation, this is the answer which you will get, the gain loss on the financial liability and the equity component in this case. Right, friends, I think that finishes my inputs in terms of Ind AS 32. Ind AS 32 is over. In the next session, as I said, I'm going to take this session for 3.5 hours on Tuesday, where we're going to focus completely on Ind AS 109. We're going to do an extensive concept revisions along with questions on Tuesday, friends. So I need to take a little leave today early, as I said. So I'm going to see you on Tuesday morning. So thank you very much for joining in, friends. I'm going to see you on Tuesday.
Much. Thank you, sir. Thank you very much.
Thank you very much. Thank you. Thank you so much.
Thank you, sir.
Thank you. Anji, thank you. Same to you.